Good morning. We're very excited to be here. My name is Olga Yasinnik, and I am Director of Audit and Assurance at AAFCPAs. I work with sophisticated health and human service nonprofits and community development organizations. And I lead an AAFCPAs Lease task force. And despite the fact that just yesterday I was in sunny Mexico where it was 85 degrees, and today I'm in Massachusetts where it's cloudy and 45, I'm very excited to be here with my co-presenter.
Hi, everyone. My name is Angie Liu, and I have been a member with AAFCPAs for about the past 7 years. And I'm also a part of AAF's Lease task force, advising different clients in different industries, helping everyone adopt the new standard. Today, I look forward to sharing some of the new accounting pronouncements with you all.
Unfortunately, Matt Hart, who is also a constant at these AFCPA's updates, is under the weather today, and he is regretting that he can't attend the seminar as he did, where he attended and presented at the seminar for the past 13 years. Also, for those people in Alaska, I apologize for throwing this, the temperatures, the probably much warmer temperatures than you're experiencing right now. Well, we're excited to present our accounting update session as part of our educational commitment to our client. The session is usually popular with this group, and we are always, every year, we keep you abreast of what's going on in the accounting world. So without further ado, let's dive in. And the first thing we're going to start is, before I start talking about my favorite subject, leases, we are going to launch a poll because I'd like to gain sort of where my audience is. Have you adopted the standard? Are you thinking of adopting? Where are you? Oh, and I see the poll is going. Okay, so far, great, of course. I think those are the calendar year ends. There's some unsures. I should get started. Yes. Adoption is almost complete. This is excellent. Okay. I like where we are. The majority of organizations, it looks like you have adopted the standard. Excellent. Okay, well, let's move on. For those of you who haven't adopted the standard, I found this little cartoon that I think is very telling. I'm not procrastinating. I am proactively delaying the implementation of this energy-intensive phase of the project until the enthusiasm factor is at its maximum effectiveness. So for those of you who have not adopted, adopted yet, which I saw that was about 20-30%, this is definitely your call to action. I'm assuming that you're all fiscal year ends because the calendar year ends had to adopt it in the calendar 2022. The fiscal year end, the 6/30 year ends, you still have about 2 months until the close of your year end books. So this is definitely your call to action. What should you start with if you haven't yet? Inventory of your leases. Determine how many leases you have, because depending on how many leases you have to make certain decisions. If you haven't adopted the standard yet, and if you have debt covenants, probably right after the seminar, review your debt covenants, because you may be out of compliance with certain leverage ratios just by adopting the standard and bringing the leases onto your balance sheet. So review your debt covenants, call your bank, modify the agreement so that you're not out of compliance just because you have to follow GAAP. And then depending on how many leases you have, you could choose to use Excel or software for your needs. We find that probably after 5 leases, Excel starts getting cumbersome. So if you have more than 5 leases, start thinking of the lease software. And obviously, as we've talked in the past, educate the users of financial statements. This is going to be a big change on the balance sheet. It's going to be noticeable so that your users understand what's going on. And then develop an implementation plan. part of this plan, what is important is not just assigning who is doing it when, when this needs to be done, but also to ensure the intra-departmental communication, that those people, those departments who sign the leases or update the leases or modify the leases always know to communicate any kind of changes to the accounting department, because on the accounting side, this is where it will take the most effort to adopt this lease standard and to continue, because this lease standard is with us. John made this joke about this lease standard sort of looming over us for years, for decades. I've been following it since 2010 when it was first, the exposure draft came out. So I'm definitely ready for a new hobby at this point. But this standard is with us. So any new leases, any changes to your leases, you'll have to go back to the standard and figure out how to do accounting, how to make the account for the changes in the lease, in your lease agreements. And then obviously what's also is most important is updating accounting policies and processing, including materiality determination, including your internal control processes. Who's approving the lease? Who is reviewing the lease? Who's approving and reviewing the accounting piece of it, and making sure that it is in accordance with your policy. For those of you who have not done that yet, how will you approach the implementation? The way AAFCPA sees it is there are three options. Option one is where our clients and organizations have enough internal resources to do it on their own. They have, capacity, staffing, they have time to dig into the standard. They can do it on their own. That's great. And then we see option three is where, as John mentioned, we're all dealing with these, staffing challenges, unfortunately. And so if you don't have enough internal resources, or, if you're 6:30 year end, you're kind of running out of time, we are here to help you. We can assist you with the full adoption of the standard. Even if you're our assurance client, we have strict guidelines to make sure we don't cross the independence line. As we've been following the standard and we know the standard is coming, and we understood how much effort it will take to adopt the standard, we at AAFCPAs prepared for it, and we hired additional people. We have a project management department who is well versed in the consulting on with this lease standard. And then there's option two, where it's sort of a hybrid option where we can help you. You can do some work, just anything to kind of make sure that you are following up and you're adopting this on time. And then if you haven't checked out our website, please do. There's a ton of different resources there, including the various lease resources, like a lease implementation checklist. There's our white paper there, and multiple webinars are there as well for you, to help you. As I mentioned before, accounting policy and processes is very important in adopting of the standard, and again, going forward with the standard, because you're going to be, any changes to the lease, you're going to be going back to your accounting policy to make sure that you are accounting for the new changes in accordance with what you originally have developed here. What kind of things should be documented in the accounting policy? Lease definition and materiality, if you're using it. And this materiality is different from materiality that you use for fixed assets. You could arrive to the same threshold, but you might not have to or need to. It really depends on your operations, what kind of materiality threshold you decide to choose, because, for fixed assets, if you think about it, though, it happens in the same year, right? Like if something is under your capitalization threshold, it gets expensed and it's gone. The leases are staying over the time, over the period over the term of the lease. So it will be with us for years. So you need to end leases. If you have multiple leases under the threshold that you choose, they might accumulate and be over the threshold, because the point of this standard is to bring all the leases on the balance sheet. There's a number of practical expedients there that may make your life a little bit easier. Some of them I think everybody should adopt. Other ones are very specific to your operations. Discount rate. I still get a lot of questions on the discount rate. And while this standard is vague on many things, it is not on the discount rate. There are only three options for the discount rate. If there's an implicit rate in the lease standard, you have to use that. Otherwise, you can choose either incremental borrowing rate or the risk-free rate. Both rates should be adopted at the earlier of the adoption of the standard or the commencement of the lease. So if your lease started in 2013, you can't go back to 2013 when you're trying to look up your risk-free rate. That is not allowed. I've also been seeing a mortgage rate that is used as a incremental borrowing rate for existing mortgages. I've been seeing line of credit rate, historical prime rate, yield of return on investments. None of those are allowed because if you are choosing the incremental borrowing rate, it is attached to the asset you are leasing because it is collateralized by that asset. The standard is very clear about that. Another thing to think about is the account structure and financial statement presentation. If you have multiple leases, the recommendation generally is that you would use individual general ledger accounts for each lease. So if you have one operating lease, let's say, then how many accounts should you have? You will have a right of use asset. You will have two liabilities accounts, lease liabilities, current and long-term, and you would have a lease expense account. So 4 accounts on one lease. So think about it, if you have multiple leases, your account chart, the chart of your accounts is expanding drastically. And then, as I mentioned before, very important to have proper internal controls surrounding the process. This is something that will, even for those who have adopted the standard, this is something that, we see is challenging going forward, the lease commencement pitfalls. So what is the date of the lease, the commencement date of the lease? Is it the date of signature on the lease agreement? The commencement date as stated in the lease agreement, like when lease agreement says that the lease is effective as of this date. Is this really the date? Or is it the first payment date? Or the date the leasehold improvements are commenced? Or is it the date the lessee has the control of the asset? It is the date the lessee has the control of the asset. So this is very important. None of those things, you would take them into consideration when you're determining your commencement date, but it's really when the lessee gets the control of the asset. Remember that the whole terminology changed, the right of use. This is when the lessee has the right to use the asset and has the control of the asset. So this is not an exaggeration, but I've been getting a question that relates to this probably a few times a week in the past couple of months. So here's a sort of a fact pattern for you. There's a calendar year-end organization that signed a renewal of an existing lease on November 15th, 2022 for an additional 5 years. The lease was expiring as of 12/31/2022 at the end of the year. This new extension is for 5 years with, let's say, $100,000 payments per year. And then the renewed agreement commences on the first date of the next year after the current lease expires, so 1/1/2023. So as of 12/31/2022, as of December 31, 2022, what is the ROU asset, the right of use asset, and the lease liability on the balance sheet? So you would think that it would be zero because this is just the end of the lease and the current lease is expiring. The new lease has not started yet, right? No, of course not. Think about what is the commencement date of this new lease agreement. And let's go, like, if you think about back to the previous slide, it is when the organization, the lessee, has the control of the asset. So as of that date, when you signed the new renewal agreement on November 15th, you had the control of the asset because you've been leasing the same asset. So in fact, your commencement date for the new lease agreement is November 15th. So at the end of the year, your ROU asset and lease liability would be about $500,000 discounted to present value. So this is very important. And again, it's going to stay with us for the, until FASB comes up with the different standard. Another tricky thing is the lease modification. Again, this is, this it happens so often, right? You're modifying the lease. There's certain changes to the lease. So what is a lease modification? A lease modification is a change to the terms and conditions of the contract that results in a change in the scope of the consideration for a lease. For example, this is a change that could be to the space you're renting, right? So you're adding a floor, or you're, subtracting, like, let's say, half the floor, or it could be changed to the terms of the lease, and now you're extending or terminating the lease early. So all of those are at least you're modifying your lease agreement. So how to account for lease modification? Well, there are two ways to account for it. You can account for it as a sort of your old existing lease, and you just make an adjustment, to account for this modification. Or this lease modification could be a whole new lease contract. So you have to be kind of very careful of how this lease modification reads. And then there's certain criteria that the lessee has to meet to be able to account it for as a new lease contract. And we all know how to account for it as a new lease contract. We've just done this adoption. But how do you account for it as a lease modification? Well, let's think about certain situations. So for example, if you're adding additional right of use assets, so let's say you're adding additional floor or additional office space, then as a lessee, you would recognize the amount of the remeasurement of the lease liability as an adjustment to ROU asset. If these are changes to the term of the lease, you're extending the lease, then the same recognition, you would recognize the amount of the remeasurement of the lease liability as an adjustment to ROU asset. However, at that point, if the ROU asset is reduced to zero, then the lessee would recognize any remaining amount as profit or loss. So now you have an impact to your income statement. And then the same as when it's a full or partial termination, the lessee will decrease the ROU asset in proportion to the termination as stated in the agreement, and then any difference between adjustments will be recognized as profit or loss on your income statement. And then this thing that's called embedded leases that, for those of you who have hired AAFCPAs as a consultant, and we've talked to you about the embedded leases. These are the leases that are hiding in the service contracts. This is something new that 842 introduced in this new lease standard. And so what kind of contracts you should be on the lookout for? So the most, you should consider all of your service contracts. Is there an underlying asset? But specifically, the ones that we see most common with where leases could be hiding, there are equipment in outsourced contracts, IT and cable internet contracts. For those of you who are storing your data as part of your IT service contract, then you need to carefully read the contract to see, is your data stored on the server that is designated to you specifically and nobody else can use it? Then just like that, you have an underlying asset and potentially you have a lease. Vending machine is another common one. The shredding boxes, I think probably all of organizations have that. These might not be material. So this is again where we go back to that accounting policy. What is your materiality, right? Plants and art. If you have this, plant service where you beautifying your offices with greenery and have these nice plants around you, these are actually assets. These are underlying assets, and you are, technically leasing these plants, right, as part of the service. Again, you should be very careful of how you read the agreement, how the agreement is written, because sometimes the way the agreement is written, then it's clear that this is an underlying asset and you can do whatever you want, with the asset during the time you control it. But other agreements are not that specific. For example, billboards, if you can only put one ad on this billboard, and they're very kind of strict considerations and conditions of what can be done, it might not be, there might not be an embedded lease in that contract. So you should use the new definition of the lease, and there's a nice lease flow chart that can help you determine whether there's an embedded lease in the contract. How may we help you? Again, for those of you who have not adopted, I would urge you to reach out to your trusted business advisor. I hope it is us. I hope it is AAFCPAs. And we can help you with anything you need, with lease classification criteria, with calculation. We can explain the technical the technical aspects of various accounting practical expedience for your accounting policy. We can assist with selecting software. Again, we have been preparing for the standard. It's with us, and we're here to help you with whatever it is that you need.
Awesome. Thank you so much, Olga, for the nice summary on the new lease standard. Next, I will give a little update on the current expected credit loss impairment model, also known as the CECL model, under ASC 326. So this standard actually it started with some efforts to improve the current accounting regulations about credit loss back when the 2008 crisis happened. And FASB had initially tried pushing out a standard with the International Accounting Standards Board, but they couldn't reach the common grounds, and therefore they pushed out their own standard, which is the one we have now. So this CECL model has been effective for public companies since 2020. Due to COVID, they deferred the effective date for all other companies for a little bit longer, but it's now in front of us. It's effective for calendar year 2023 and fiscal year 2024. So in order to apply the new standard, you want to adopt it on the first day of the fiscal year when it becomes effective, and you will recognize any impact of the adoption through a cumulative effect adjustment to equity. So now let's take a look at what's in the scope of the new standard. Here is a list of everything that's within scope. And we know this standard really has a big impact to the lending industry. But in addition to the loan receivables, bond investments, it also impacts any receivables under a Revenue 606 transaction. So this means if you have any AR from program fees, parent fees, client fees, and if you have developer fee receivable, third-party AR, this is all within scope, and we'll need to apply the new standard to these items. And next, we also wanted to look at what's not included in the scope. So if you have a receivable under a Revenue 958 contribution, then that's excluded from the CECL model. And also, if you have, say, a grant receivable from the government, and you're not a contractor for the government, but more like a grantee to the government, then that's also excluded from the scope. One other item is any intercompany receivable between entities under common control. Those receivables are also excluded. So now we have looked into what's in the scope and not in the scope. Let's take a look at the differences of the new standard compared with the legacy model. So the first difference is that the new standard requires you to reflect the risk of loss even when that risk is remote. So under the new standard, treasury bills are viewed to have no credit losses. But pretty much all the other assets that are within the scope are viewed to have some level of credit risks, and those credit risks must be recognized on the first day of obtaining those assets. The second difference that I wanted to bring to everyone's attention is how the risk loss is measured. So under the new standard, we'll need to use a portfolio approach. You can categorize the assets into a portfolio or multiple portfolios. So for example, if you're a healthcare organization and you work with different insurances, you could categorize, say, Medicaid and Medicare AR as one category, and receivables from larger insurance companies that you have a long standing relationship with into another category. And you can categorize those newer insurance companies into a third category and assess the credit loss accordingly. The next difference is that the standard requires us to both consider current conditions as well as future forecast, and it cannot be assessed with a historical loss alone. So the legacy standard already asks us to consider current conditions, but now the future forecast is something that's new, and we'll also need to take that into consideration. When it comes to future forecasts, the standard asks us to focus on the two keywords, reasonable and supportable. And I really like this example from the standard that I wanted to share with you all. So it says there is a lending institution in a local town, and they have experienced increasing loan loss for the past couple of years. And they noticed that within the past couple of years, unemployment rate also were increasing. So in other words, there is a correlation between the loan loss that they were experiencing and the unemployment rate. And based on that, when they adopted the CECL model, they noticed the unemployment rate actually went down that year. So accordingly, they adjusted their reserve to be lower than before. So this is an example where it shows we cannot make an arbitrary future forecast and predict how tomorrow is going to be. It will need to be supported by actual facts and evidence. But it also shows that actually adopting the standard will not always cause you to have a higher loan loss reserve. It could actually, you may actually make a downward adjustment as well. All right, so next, we wanted to touch on the methods available for you. So the standard is very flexible with the type of method that you can use to estimate the credit loss. You could use the discounted cash flow method, which means you would discount all future cash flow to the present value. You could also use a probability method. So this could mean estimating how much percentage is going to be defaulted and apply that to the percentage of the principal that may be defaulted. So for example, if you have a $1 million loan and the default rate is estimated to be 2%, and you estimate that if this loan is defaulted, that you may not recover 35% of the original principal, then you would then calculate the estimated credit loss to be 1 million times 2% times the 35%. And there are many other methods that are also acceptable under the standard, such as the good old aging method and estimated loss rate. The list goes on. The standard does not require you to use a computerized model, so you can use both qualitative factor and quantitative factor to assist you with the analysis. So now let's summarize the key differences under the new CECL model. When you adopt the CECL standard, you will want to record lifetime credit losses, and you will need to record that on the first day of obtaining that asset. You want to use a portfolio approach, and you also want to consider both current and future economic conditions. And the keywords are supportable and reasonable as it relates to the future economic conditions. So will we be able to launch a poll at this moment? Awesome.
Great, thank you, Angie. And while the poll is you answering the poll, I see that there's some questions that came in. So Angie, there's a question regarding the patient service receivables. Would that be included as part? Is it in the scope of the new standard for CECL?
Yes, I would say so, because the patient service receivable that will be under a revenue 606 transaction, it will be a receivable under a contract with the customer. So because of that, it will be within scope. Thank you for asking the question.
There was another question about leases. We have a 90-day lease that auto renews without a specific limit of renewals. How should this be handled? Or is this practically exempt from the standard? You would think it would be exempt from the standard because you think it's a short-term lease. But in reality, you would need to assess how long are you actually planning to renew this lease. Because if you know that it will only last 90 days, or if you know you're going to be renew every 90 days, but you will end it before 12 months, then yes, it's a short-term lease. But if you know you're going to stay there for the next few years, then you should probably do your best estimate of how long will you stay there. And this, in fact, would be the term of the lease, and that's how you should record it, present valued, and record it on your balance sheet. That's what we have so far in questions. We will leave a few more minutes at the end of this presentation for questions. And then don't forget that there's going to be a breakout room later on this afternoon. And please join us with any questions you have, leases or any CECL or any other accounting standards.
Awesome. And thank you for answering the polling question. Just wanted to remind everyone that AAF is a resource, and we are available to help you with your efforts in adopting the new CECL standard. And I know the standard is quite complex and pretty vague as well, but we're here to help you. Awesome. I believe we have two other accounting pronouncements that we just wanted to give you a quick update of. So the first one is the reference rate reform. So as we know, the LIBOR rate is going away, but originally it was going away at the end of 2022, but now it's pushed out to June 2023. And as a result, FASB pushed out this standard to allow for a longer period for the temporary accounting relief. So you can use the shortcut method to account for any interest rate swap contract involving LIBOR rate for a little bit longer until December 31st, 2024. And the next one is on business combinations. So currently under the guidance before this ASU, you are required to assess any assets and liabilities obtained in a business combination and assess them to be fair value. But there are a couple of exclusions, such as income taxes, employee benefits, and a few specific exclusions. So this ASU now excludes contract asset and contract liabilities as one of those items that you don't need to bring up to fair value as you go through the business combination accounting. And it goes if the acquired is already properly following topic 606 and reporting contract assets and contract liabilities, you may take those balances and put that on your balance sheet. And if they were not following topic 606 properly or not in compliance with GAAP related to that, then you would almost put yourself in their shoes and assess what that contract asset and liabilities would have been under topic 606 and record the balances accordingly, but you do not need to use fair value. And this standard is effective for calendar year 2024 and after. Awesome. Do we have any new questions that come in?
There was a question that I was asked before is about the very long-term leases. So when I said about the discount rate, that the standard is pretty strict on what the discount rates are, and there are only 3 options. For the long-term leases, so if you think about if you have a lease for 99 years, which is not unusual in our nonprofit world, what would you use? We don't, the banks don't give you a 99-year loan, right? So they're not kind of equipped with giving you the incremental borrowing rate. And there's no, if you look up the Treasury website, it stops at 30 years, the same as the banks. There are other countries that use the 90 or 100-year rates. So there's going to be a lot of sort of assessment and consideration and documentation of what rate do you choose to use for the discount for those long-term leases. So this is something important and not as straightforward. Thank you very much for staying with us during this first about 40 minutes. Here's our last polling question for the session. What are your main takeaways from today's session? All right. Well, I'm glad that people feel prepared for the changes that we've discussed. Okay. Excellent. Well, again, thank you very much for joining us for this session, and I hope to see you in the afternoon. And please enjoy the rest of the seminar.